Afternoon, participants. A warm welcome to ASK Investment Managers Quarterly Portfolio Update Call. My name is Ramakrishna and I am the moderator for today's call. We are all witnessing markets are so volatile recent times and also down by 9 to 10% in last 2 months. So it may be because of various reasons like valuation concerns, FI selling hugely from the emerging markets, and there are some sort of global crisis like war-like situations, and maybe muted corporate earnings. So in this context, to know more about how the markets are shaping at this point in time, and also to update on our portfolio, ASK Domestic Resurgence Portfolio, and in this current market situation, how the portfolio is constructed and how the portfolio is positioned. To update on this, we have Mr. Kuldeep Gangwar, who is the Senior Portfolio Manager and managing ASK Domestic Resurgence Portfolio. Kuldeep joined ASK in January 2018 and is having overall 18 years of experience in equity markets, including over a decade as a sell-side research analyst. His core domain is on consumer sector, especially in FMCG and retail. Prior to joining ASK, he was associated with HSBC Securities and Capital Markets Private Limited as a sell-side research analyst. He also worked with Tata Motors for 3 years. Kuldeep is MBA Finance graduate from IIT Mumbai and BTech from IIT Roorkee, and he is a CFA chartered holder. So without any further delay, I will hand over the baton to Kuldeep. So post his presentation, we will have the Q&A session. Request all the participants to type all your questions in chat bar, and we will curate at the end of the presentation and we'll get the answers from the Kuldeep. Over to you, Kuldeep.
Hi, everyone. Thanks for joining in. Good afternoon. So whenever we discuss about any portfolio strategy, it also matters like the environment we are working in. So first of all, like global event currently points toward a mixed picture. We have already seen that in US, the Republicans have won, and it can have quite a significant meaning for the policy stance perspective. The more visibility will be coming most likely in January next year, and it can have a meaningful impact on, say, global trade and the non-trade, as well as energy. We have seen in the recent past that China has announced both the monetary as well as the fiscal stimulus to address the concern related to the growth. We expect additional measure based over, say, policy measures being taken by US in January 25. If we think about European economies, the growth remains subdued. Currently, the global GDP growth is supported by US. So far, US Fed has cut about 75 basis points, and the further rate action will be dependent on the fiscal policy measures taken by the new dispensation. Geopolitical tension, especially in Europe and Middle East, continue to remain elevated. If we think about, say, overall market performance perspective, India had almost 10% CYTD performance, one of the better performing market, and in the longer tenor, say 5 year, probably the best performing market globally. Crude oil is say quite an important factor as far as the country is being concerned, because we import a large part of our requirement, and it is having a lot of implication for, say, current account deficit and to some extent fiscal deficit as well. So far, it is in that, say, $70 to $80 range, and a relatively more benign situation vis-a-vis, say, a couple of years back when all of a sudden there had been a spike post the Russia-Ukraine war. So from the crude oil perspective, it's a relatively more manageable and better situation to be in. Domestic situation, so far, if we look at CYTD 2024, say IMF has raised 2025 growth guidance by 50 basis points to almost 7%. Food inflation had been quite sticky, and it led to a spike in CPI, basically the inflation part. RBI has changed its say stance from neutral to withdrawal of accommodation, which suggests that there should be calibrated easing in coming quarters. Fiscal deficit had been close to 30% vis-a-vis overall FY25 estimate. Growth is expected to be driven by government spending and revival in export. Consumption growth had been mixed bag, like certain segment, two-wheeler and consumer durables reported strong numbers, while other discretionary segments have been weak. It may be because of the extended monsoon and the early festive. There is a lot of hope that in second half, many discretionary sector should do well because a lot of weddings are going to be in the second half this financial year. Management commentary point towards a recovery in rural demand, but at the same time, they are concerned related to, say, some weakness in the urban demand overall. From, say, valuation perspective, we have seen, say, almost 8 to 10% correction on the Nifty level in last 1.5 months. So currently the valuation have come down to, say, 20.5 or so, which is quite close to the 10-year average. So to some extent, the concerns related to the valuation stretch are being taken care of after having the decline which we have seen in last 1.5 months. If we come to domestic resurgence portfolio strategy, and first we talk about what had been the case in FY24, we have seen that certain elements of the portfolio, whether it had been the consumer discretionary, chemical, financial, and PSU, where we had the underexposure, dragged the overall performance. So from the chemical sector perspective, though we believe that from medium to long-term perspective, India is going to have better standing in the global arena, led by China +1, Europe +1. But at the same time, it had taken a lot more time vis-a-vis our anticipation. So we have brought down our exposure in this particular sector. On the contrary, consumer discretionary sector, though it was weak in FY24, we do believe probably in second half FY25 onwards, there should be strong growth in this particular component. So we have raised, say, some weight in this particular part of the portfolio. Financial exposure had been a drag to some extent by the NBFC exposure we were having and relatively lower allocation in the PSU banks. In FY24, say PSU, which had almost 10% of the benchmark weight, delivered almost 90% return, and which led to, say, benchmark having significant, good picture as far as the overall return being concerned. We have tried to address most of those white spaces and whatever we believe that, say, action need to be taken, we have done the same in FY25. And we have increased our exposure in the industrial manufacturing infrastructure, and it has delivered decent return in FY25. So whether it's our exposure in, say, manufacturing exposure in polycap, capital good exposure of power industries, transformer and rectifier, which essentially are the play on the industrial and the capex activity, they have done relatively well. The telecom exposure like Bharti, commodity exposure of Gravita, staples like Patanjali Food, beverages like Redigo Khaitan, they also delivered the decent return in FY25. From the focus area perspective, we believe that infra manufacturing is theme for the next decade. And there had been some concern in last 6 months, especially post the general election. But we have a strong faith that recovery in industrial capex, which is being led by, say, government and PSU spending, it's going to have further led by, say, private capex as well. We are seeing massive investments in the green power. The balance sheet of the corporates are good, while the capacity utilization rates are increasing, which suggests that the private investment should also improve. Digitization-led opportunities, whether it's a data center or the 5G investment, also augur well. We believe this defense and railways are again not a theme for a year or two, it's a theme for decades. And we remain quite, say, hopeful that these particular subsectors should also deliver the strong growth prospects. Power, energy transition, automation should be also a strong growth area for many years to come. And the policy initiative like PLI are boosting employment opportunities as well as should help in the better earning growth in many manufacturing space companies over there. Along with that, we also believe that discretionary spend should come up, and higher incomes in coming years should also help to have higher penetration in many under-penetrated areas. These are the actions being taken in last 6-7 months. So on the left side, you can see that we have increased our exposure quite meaningfully on say industrial manufacturing on capex part, and some of that exposure have delivered a pretty decent outcome, whether it's a Gravita, Apar Industries, Bharat Electronics, and Transformer and Rectifier. And we are quite hopeful that rest of the things should also catch up and deliver better return in time. At the same time, we have exited, say, some of the financial name, whether it's AU, SDFC Bank, Bajaj Finserv. We have also brought down our exposure on the chemical side and so on. In the last 3 months, we have added two positions. One is the Emcure Pharma. So just to brief about the Emcure Pharma, it's a, say, private listed. It used to be a private limited company and became listed in July 2024. The company is having almost 86% revenue coming from, say, formulation. API is having 6% contribution. Contract research and manufacturing is having close to 8%. In terms of the, say, geographical exposure, 50% of the sales come from India and balance 48% come from the export market. It is to be noted over here that out of the export, say Canada is 14%, European Union is close to 22%, and rest of the world is 16%. It's run by a first generation entrepreneur, and the company is having close to, say, new sales force addition of close to 1,200 sales representative, as well as the 4 new manufacturing plant. And we have to note that these additions should help, say, better earning growth in time to come as and when the utilization increase. In FY24, operating profit margins were impacted for different regions, whether it was related to acquisition, related cost of litigation, and so on. And we believe these are the things of past, and FY25 and beyond, the margin should improve. In the current year itself, the company had a distribution agreement with the Sanofi, which should also provide almost 450 to 475 crore, say, revenue for the company. And out of, say, 2100 crore IPO proceeds, the company has brought down its debt meaningfully over there. From the growth perspective, it should be among the fastest growing, say, pharma companies. From earning growth perspective, we believe the current year, the company should report almost 40% earning growth, and next year as well, almost 20% earning growth. So it should be, say, top quartile as far as the pharma sector is being concerned. So that way we have increased our overall pharma exposure. And now we have 2 companies in that domain. One is the Mankind Pharma and second is the Emcure Pharma. Next, we have included the PDS Limited. It's a consumer discretionary company, and it's basically a platform working in the textile area. So they bridge the gap of, say, retailers' demand versus, say, supply side companies like textile companies over there. It's a good ROC business and having a meaningful revenue and EBITDA if we think about it. In terms of exposure, almost 38% come from, say, UK, European Union is about 33%, Asia and Middle East is close to 14%, and America is close to 13%. They are working a lot on the America part, and its revenue contribution should increase in FY25 and FY26, as well as even many years to come. So they have made a lot of investment in FY24 and FY25, which had some impact on the profitability part in FY24. It should correct in FY25, and there should be step jump as far as the profits are being concerned. So we expect almost 70% earning growth this year from the relatively benign base of FY24. And on the FY25 base itself, we expect almost 30 to 40% growth in the earnings for next 2-3 years. So reasonable valuation working in an area which should benefit from, say, overall better prospects in US and other markets. So this is a play which is working more like a bridge from, say, textile companies, which are the provider, and the companies, retail companies like Walmart and Target, Prima, others as a customer over there. So we are quite confident the earning growth should be there for many years to come in this particular exposure as well. Overall, if we look how the DRP has evolved over last 5-6 years, so we used to have some exposure in the infrastructure and engineering side, almost 10% in 2020, and every year we have increased the exposure, like it increased to almost 20% in 2021. As we speak, almost 30% of the exposure is coming from that infrastructure, engineering, manufacturing part, and we believe that it should deliver because we believe this is a theme and which is going to have its time, not for a year or two, but for many years to come. In the meantime, we have brought down the exposure in consumption, and it's largely restricted to, say, more discretionary side of the consumption rather than the FMCG part of it. On the financials also, we have brought down the exposure. At the same time, we have increased the exposure towards, say, utilities, commodities, automobile, and so on. So now the portfolio is quite broad-based and quite aligned to, say, overall economic growth prospects of the country. This is again, say, a snapshot of a DRP positioning vis-a-vis BSE 500. So we are significantly overweight in the infrastructure and engineering part, almost 30% weight vis-a-vis, say, 12% in the BSE 500. Consumption is again overweight area, despite some reduction in the weight in the overall portfolio. So consumption is close to 20% weight. As I mentioned, beverages is close to 9 to 10%, and balance is coming from, say, retail and footwear, etc. Utilities was another addition, whether it's a port or power utilities, and commodity is more about, say, recycling company over there. So we are overweight on infrastructure, engineering, and consumption. We are relatively underweight on the financial part. So this is from the portfolio psychographic perspective. From market capitalization perspective, 46% is large cap, balance almost 50% plus is coming from mid to small cap. If we think about Q2 FY25 earning, then auto ancillary was an area where the two-wheeler performed well, but there was some muted growth in the PV or, say, commercial vehicle or the tractor side. In the banking and financials, higher cost of fund had the impact on net interest margin. Credit cost was slightly elevated, which impacted the PAT growth. And companies which are exposed to the capital market did relatively better. On the consumption front, the inline estimate performance and barring consumer durable, the things were relatively below par. Commentary for festive has been mixed. There is expectation that a higher number of wedding days should partially offset the negative impact of the relatively extended monsoon. Management commentary pointing towards, say, some recovery in the rural demand. At the same time, urban demand is a concern for a while. On the chemical and pharma side, inventory destocking and pricing pressure continue to negatively impact the overall chemical sector performance, though there is expectation that there should be some sequential improvement over there. And the same is being reflected by the management commentary that as to second half of the FY25, we should expect some recovery on the volume front. Engineering, industrial, and capital good had a mixed bag, led by, say, general election related issues, as well as, say, execution impact led by, say, extended monsoon. We expect there should be some pickup in the growth momentum, especially in the second half of the FY25. Oil marketing companies, refining margins were relatively impacted by, say, overall international margins as well. And there were some losses in LPG. But expectation is again that probably the worst is over, and Q3 itself we expect better GRM as well as better retailing margin, which should take care of, say, LPG losses as well. So we expect probably the worst is over for OMCs, and the better performance should be there in coming quarters as well as coming years. Pharma and healthcare. So pharma company deliver a stable volume growth and lower input cost help the margin expansion. Overall, if we think about DRP portfolio, the revenue growth was close to 18%, operating profit close to 16%, and almost 20% earning growth. And this number is meaningfully higher vis-a-vis say Nifty, where say earning growth was single digit, and same was the case for sales and the operating profit. And this is something where the portfolio had been quite consistent, whether we look last 5 year, last year, the current year, or the coming years. That earning growth had been delivered and should continue to be delivered. For full year FY25, we expect that DRP should deliver almost 20% plus earning growth if we exclude the OMC part of it. Vis-a-vis the Nifty delivering say single digit earning growth this year and probably mid-teen next year. From portfolio psychographic perspective, say valuations have moderated in last 2-3 years. At the same time, earning growth remain the robust. And this is a part I already mentioned that even if we think about last 5 year perspective, the earning growth had been quite robust. Like portfolio level, the earning growth had been almost 20-25%, vis-a-vis Nifty delivering 16% earning growth. The valuation is the only concern we had, say, in last 2-3 years. But if we look this particular chart, currently the valuation have come down dramatically, and probably it's quite close to the trough being experienced in last 4 years. So hopefully the valuation should not be a major concern for years to come. And if the further valuation derating is not happening, then the earning growth should translate into the stock return or the portfolio return, where we are quite confident that earning growth should continue to remain robust. And that's the reason we expect relatively better performance in coming quarters and years. If we think about portfolio performance perspective, last 3 months had been relatively better, and same is the case with last 6 months. There had been some recovery, and we have covered some of the lost ground. Even from full year FY25 perspective, they had been say almost 2 to 3% alpha as on October 31st. So we have done many changes, and some of them have already delivered, say, in terms of return perspective. And we expect that rest of the things also follow. And given the overall portfolio is quite diversified, better aligned, and more tuned to the way the overall economy will be performing, we remain quite hopeful that the incoming quarters, years, the performance should be relatively better. These are the names which have done well, like Gravita, Radico Khaitan, Mankind Pharma, Trill. They have contributed meaningfully to overall, say, portfolio return, and we have decent exposure to these names. So we are putting a lot of weight behind our conviction. And the similar is a case from a year perspective as well, like Gravita, Radico, Varun, etc. have done quite well. There had been drag in some of the name where we have either brought down the exposure or we have made some exit. So we do believe that the positive part of the portfolio should contribute a lot more vis-a-vis say the drag we have seen in some of the quarters. From the risk perspective, the crude oil always dependent on how the geopolitical situation pan out. Second thing would be that when there is change in the say distension in US in January, how the policy pan out over there and its implication for the rest of the world. Third part, like how the currency will behave, how the global growth will behave. So these are the things we should be quite watch out for, because it's going to have implication for say overall markets in general. I will stop over here and will be happy to have any question which you might be having.
Thank you, Kuldeep. Thanks for your detailed presentation on DRP positioning. Participants are requested to type all your questions in Q&A chat box, so that I will ask the questions to the Kuldeep and he will answer all the questions. So before participants type the questions, Kuldeep, we also curated some questions from our partners and investors. So the first question again, comes for that, we have seen sharp rally the last 2 years in the value side of the markets, and again, growth is stubborn at that point in time. Now, how do you see the growth style of companies will come back at this current situation? And it is very clearly evident that in a shorter period of time, in the 1 to 9 months period, DRP portfolios outperform the benchmark. But there is a still lot of room and a lot of catch up is required for the longer term for a 1 to 5 years period versus benchmark. So, what is your thought to the investors? When can they expect that the outperformance versus benchmark, and again the growth style, how we are looking as a portfolio manager?
So, if you recall from almost September 21 onwards, we have seen one way interest rate upcycle, and it continued to happen till last year. And since then, there was a pause for almost a year, and recent times we have seen the interest rate cut. So think from the say perspective that whenever the interest rate are rising, and that too with a good quantum, it's not a good news for growth economy, growth sector, and the growth stock, because a large value is being created over a longer period of time. So discount rate factor, say the kind of premium we are paying, all those things do matter. So if interest rate are higher, say asking rate by the investor also go up, and in those scenarios, say overall growth pool gets suffer. Now the cycle is reversing. Like we have already seen the, say, European Union has started the cut, and it is being followed by the Fed. Fed has already cut 75 basis points, and hope is there should be, say, future cuts either in coming months or say next year as well. As and when it happen, like when rest of the world is cutting the interest rate, at some point of time, probably we will also follow the route. And when it happen, it's a good news for again growth economy, growth sectors, and the growth stock. So what we have seen that for almost 2 years, the value was doing relatively better, and growth was getting some sort of backseat, both from say narrative perspective as well as the delivery perspective. We expect there should be say change in the essence, and hopefully say growth related pool should do better as and when this interest rate cycle start happening even in our own country. So that is one part. What happens, like if particular pool is doing well, then over a period of time, the valuation of that particular pool also inch up. What we have seen in the value stock. At the same time, if something is not working, like the growth has not worked for quite some time, almost 2 to 3 years. So despite having the earning, there was a derating, which made the valuation relatively more reasonable. So we do believe that today the valuation are relatively more say favorable as far as the growth pool is being concerned. At the same time, there should be enough tailwind available to deliver earning growth. There had been some concern like Nifty having relatively modest earning growth in FY 25. But the way we think about it, like it's being brought down by say OMCs, which had superb say stretch in FY 24. After that, relatively say more muted earning in first half FY 25. If we exclude the OMCs, even for Nifty, there should be almost 10% earning growth. So whatever we are seeing, OMCs had some bearing on the reported number, which look optically lower. On FY 26 or and FY 27, we expect there should be mid-teen earning growth even for Nifty, and our own portfolio should deliver even much higher number. So earning growth remain to be quite supportive. At the same time, valuation have become a lot more reasonable, especially after the correction we have seen in last 1.5 months. So the confidence level is relatively higher that earning growth should translate into the meaningful stock return as well.
Thanks, Kuldeep, for your answer. So one of the participants, Mr. Sanchit Minda, is asking on, as you mentioned in your presentation, we have increased our exposure to infra and engineering. So he's asking that, if you are increasing this exposure, he's asking about that, whether it is a prone to recession risk if that started in US. So what is your take on that? And also continuing, he's also again asking that, the shift from traditional way of investing into capital market investments. So how will this have an impact on markets and as well as hold on our DRP portfolio?
So first of all, the expectation is that whatever we are listening, we are reading that the new dispensation in US should start, say, cutting the tax rates over there. This is one of, say, poll promise over there. And if it materializes, then it can lead to better corporate earning growth in that particular area. Probably US may have a decent GDP growth and probably one of the better performing market. And if that is a case, it should be supportive to the global growth rather than the risk of, say, recession, which was a bigger concern for almost a year or two. If we think about, say, capital goods, infra, manufacturing, so look what we are doing and where we are doing it. If you think about, say, power requirement. So today the requirement is on both the part, traditional energy, traditional power requirement, as well as the renewable energy. And who are, say, beneficiary of that particular requirement. So we have taken the exposure on both part of it. So whether it's a REC, which provide the loan to, say, power generators, as well as, say, renewable players and so on, which should continue to deliver pretty decent loan growth. And it's also coming with relatively reasonable valuation. Second part is, say, other beneficiary like transformer rectifier. So whether it's a local or, say, global, one thing is quite common that people are going to invest in the energy, and transformer sector as a overall, whether say international or domestic, is having almost 5 year, 7 year period available where they will be delivering pretty strong growth for the sector as such. So for transformer rectifier, where we had taken the exposure, the way we think about it, in FY25, this company should deliver almost 160 crore sort of profit. This number should increase to almost 250 to 300 crore in FY26, and again 400 plus in FY27. So we are not talking about, say, incremental earning growth in this particular company. In FY24, the number was hardly 40 crore. So there is a clear break from the past. Okay, so we are talking about step jump. And similar is situation for many other, say, exposure over there. So whether it's a Polycab, KI industry, and APAR industries over there, one thing is quite common: the world need the cable, whether the rest of the world or our own country. So whenever, say, capex is happening, infra is happening, the cable do come into the picture, more predictable, more compounding nature. If they have delivered, say, low teen sort of top line growth, we believe next 5 years the organized player should deliver 15 to 20% CAGR from the top line perspective, and it should also come with the margin improvement, and they should benefit both from, say, domestic play as well as the international play. So we are still not moving away from our overall approach. Like, we look for big opportunity, compounding opportunity, rather than one-time opportunity. So whatever the name I have mentioned, we are talking about pretty strong growth year after year, not a particular year we are talking about over here. So whatever the concern we have seen or read in last 6 months, we believe it's a blip in the overall story. It does not have any meaningful implication when we think in years. For next 5 year perspective, we are quite confident both, say, capex, industrial should do well, and it's going to have implication for, say, overall employment and, say, rest of the consumption as well. But we believe this area is going to deliver.
Great. Thanks, Kuldeep. So if I ask about another question on Adani Group, where we have seen from last couple of days, the news has come that how the recent allegations what Adani Group is having, though we don't have the company which is Adani, green energy, which is part of the particular allegation, but we have significant exposure not only in DRP across all other portfolios, also Adani Energy and Adani Ports and Such. So how do you see this situation for Adani as a whole group, where we have seen significant drop in the stock, yesterday 18% and 13% respectively for energy, Adani Energy and Adani Ports and Such. What's your view and what's your thought on that?
So two things, like our overall exposure, if we talk about, say, DRP, the combined exposure will be close to 5.5%. like 3.5 would be in support, and close to 2.5 would be in case of energy solution. So this is our overall standing. And look, if we think about Adani Port, it's the largest player in the port domain in the country. So we have bought those companies for the real estates they own. And same is the case with the Adani Energy Solution. Like what the Adani Energy do? It's a leading player in the private domain for transmission, distribution, as well as the smart meter. So they have the real estate. They have the history of strong profitability in past. And our expectation is that Adani Port should deliver 15 to 20% earning CAGR for near to medium term. And Adani Energy Solution may have even higher figure, like the CAGR may be 25% plus. Okay. So from fundamental side, those companies have delivered, should continue to deliver, well aligned to the direction in which the country will be moving, because they are the leading player in the respective domain. Okay. So we do not foresee any challenge from, say, delivery perspective over there. Those are the real assets delivered in past, should continue to deliver in years to come. When the valuation correct in the JFE in a short period of time, the valuation become relatively more reasonable. They were already reasonable in these companies, but they become a bit more reasonable. Second part, like certain allegations are being made, and there is a legal process. It takes time, and there is very limited information available as we speak. So having a knee-jerk reaction is having no meaning. Like, we have to analyze the overall situation, because it's not happening for the first time. Even 2 years back, the similar situation panned out. And ultimately, we have seen over a longer period of time, if the companies are having real estates, delivering good number on the ground, and if there is a perception gap, okay, at time relatively better returns are being made in those areas. So admittedly, we have close to 5.5 exposure, 5.5% exposure in these two names. We have already seen meaningful correction, and currently we will be evaluating based over, say, how the things evolve in time to come. But at the same time, we don't have any doubt regarding their ability to deliver the operating performance. Okay. So, which is the anchor part of the investment thesis, if I have to say so.
Great, great to hear that from you, Kuldeep. So if I ask on that, your core domain, which is into the consumption sector, what you closely watch, as you mentioned in the presentation that, monsoon season are good, but, it has extended this year again. And also the festive season also come little early this year again. But again, the major concern is that, food inflation is continuously in elevated level. So how do you see the entire scenario as a consumption behavior of the investors, consumers at this situation, and especially in a retail segment, discretionary segment, what we are having more allocation in the thing. The followed that, we have a couple of stocks which is into the discretionary segment, Metro Brands and Titan. It's little bit slow laggard in the portfolio returns for a period of time. So what's your take on those two names also? Can you please explain to our participants, please?
Sure. So in the consumption domain, there are two parts. One is the staple FMCG sort of part of the consumption. Second is more discretionary, where the even consumer durable and say retail players, footwear players, jewelry players, etc. come. From FMCG perspective, the way we think about it, if pre-COVID, these companies were expected to deliver mid-teen earning growth for many years to come, that number has come down dramatically. Today, say, ability to deliver double-digit earning growth itself is an issue. Reasons may be many, because two things happen. Like, obviously, the penetration of many categories has increased. At the same time, there had been many challenges on inflation front, so the companies couldn't pass it on. There could have been some down trading. Margins have already reached to the level where the scope for further margin improvement is lower. So net, if I have to say, the ability of that part of the, say, consumption universe to deliver a stronger earning growth has impaired. vis-a-vis pre-COVID. Like expectation should be relatively more modest earning growth in that domain. We do not have any meaningful exposure in that particular area. We have Radico Khaitan, Varun Beverages. Those are the companies which have delivered strong earning growth in past recent years, and we are quite hopeful that those companies should continue to deliver 20-25% earning growth for at least 3 to 5 years, at least. So that is the kind of exposure we have taken in the FMCG part of it. Now, if we come to retail, so retail, obviously, there had been a tough time for different reasons in last 1 year, whether it's a wedding days not being there, inflation hurting, reasons may be a plenty. But we have also seen one thing, like there are certain good franchisee, as and when we get the first sign of the revival, stocks do perform. So same thing we have seen in Manyavar, which is again the part of the portfolio. So we have seen like the stock came down from 1400 plus level in December last year to almost 900 level within 3 months or 4 month time span. Q2 was good, relatively better than expectation. Second half is likely to be much better, and that the stock has again come back to 1400 plus trajectory. So we have seen sharp, say, movements within a year, like 1400 plus moving to 900 and again 900 coming back to 1400 plus. So they are good franchisees. Sometimes that the performance get impaired because of say macro challenges. As long as the ability to deliver say earning when the relatively benign situation are there or relatively say a stable situation is there, persist, market recognizes. Same is the hope with something like Metro Brand. Like last 1 year had been challenging for the company. We will like to believe whether it's a Q3, Q4, or in the worst case scenario, FY26 should be meaningfully better than what we have seen in last couple of years, because they are doing a lot of product restructuring, launching new format and so on. So we remain confident this company is going to have good future. At the same time, so at times it's more of a matter of lead and leg. So the performance turnaround should be there in coming quarters and stock return should follow. From the Titan perspective, we trimmed the position long time back when the price was favorable. Right now we have a couple of percentage weight over there. And if we think about sector perspective, we believe this custom duty cut is quite a beneficial thing for the overall organized players. Everybody should benefit. Range may vary. Last 1 year had been challenging for different reasons, whether it's elevated gold prices, having some implication for say competition, demand, and so on. We expect that the jewelry as a sector is having a potential to deliver 15% plus top line growth and relatively better earning growth. And the stock prices have corrected, then the valuation also become reasonable, because in these franchises generally valuation is the bigger concern. Earning growth may be having some blip in between, but sooner or later it catch up. So having this combination like better earning growth prospect at the same time, say relatively muted delivery on the price performance side, augur well for the future return, if I have to summarize.
Okay, thank you. So participants request to type all your questions in Q&A chat box. So Kuldeep, if I ask you in terms of market capitalization, so you mentioned that more than 50% is now into mid and small caps, which is already in terms of valuations or slightly elevated level. Going ahead, how do you see the portfolio construction? Will continue with the mid and small caps, or again you increase the exposure to the large caps?
So the way I will put it, it's more driven by bottom up rather than having this say large cap, mid cap, small cap in mind. It's more about the areas where the opportunities are emerging. Take the example of Gravita. So we took the same about 6 months back. It used to be a small cap company. We bought close to 900 to 1000 level. And within short period of time, there was more than 100% price movement. And we did not go to Gravita for being a small cap player. We took the Gravita because it was the leader in the area which was emerging, like recycling as a theme. So it was the largest player in that particular area. Okay. So if the opportunity is big, offer relatively higher growth opportunity, we look for those players, whether they are coming from say large cap, mid cap, say small cap, it's a derivative. Second part, like if you look about trail, transformer rectifier, that area having all the leading players coming from say small cap only, but that is an area which is offering almost 5 to 7 year say growth trajectory, and that too meaningful growth trajectory. So you will have to choose the player which is coming from that particular market cap only. Okay. Now you take the example of say Radico Khaitan is still a small cap player, though the market cap will be close to 30,000 crore or so. So our portfolio should be look from the overall say cap as well as the growth potential perspective. And within the mid cap, the market caps are on the higher side. Within the small cap, again the market caps are on the higher side. So median market cap itself will be more than 1.5 lakh crore. So we do take into consideration many risk aspects, say liquidity aspects while we build the portfolio. So these caps are are derivative. Ultimately, we are looking for higher growth opportunities and emerging leaders in those domains.
Thanks, Kuldeep. Again, to re-emphasize on our core philosophy that not looking into the caps like whether it is a large, mid, and small, but it is more important that how big is the opportunity and how good quality stocks will generate good returns for the longer period of time. Thanks for again re-emphasizing that. So with this, if I ask you the question on the financial side, NBFC side, so we have Bajaj Finance and Cholamandalam in our portfolio. So what your view on Bajaj Finance, especially, we are holding for so long period of time, but it is, continuously driving the portfolio return in terms of longer period of time. So what's your view on that?
So we used to have both Bajaj Finance and Bajaj Finserv in past. And in last 6 months, we have taken out Bajaj Finserv. They belong to the same group. And Bajaj Finserv derive a large part of the value from the Bajaj Finance. So in other words, we have meaningfully lowered our exposure in that particular name. At the same time, think from the Bajaj Finance perspective, like probably this is among the only few NBFCs which are delivering more than 25% NII growth. There had been some increase in the credit cost, but still we believe it's more of a quarter or year phenomena rather than anything changing from sustainable basis. So from earning growth perspective, we believe probably this will be among the best performing NBFC franchisee. Similar is the case with Chola. Like these two players, we believe the earning growth can be in the range of 20-25% at least for next 3 to 5 years. For different reason, like whether it's a BFSI overall pool, we have seen material derating has happened for whether it's a private banks, even otherwise. So from pre-COVID level, many players in the BFSI domain have seen the derating. Today, multiple, if you talk about say Bajaj Finance, if it used to be 6 plus price over book, it's only 3.5 as we speak. It already factor in say so-called concern related to like relatively lower or ROE as and when it become bank. We believe it's still some time away. But whatever the concern could have been, a large part of that is already in price. That's one part. In case of Chola, like we have seen there were some concern related to the new emerging business, which led to relatively higher credit cost. Company have decided to brought down, say, relatively accelerated growth in that particular domain. So hopefully the quality is not going to be issue in time to come. And after say almost 20% correction in the name, the valuation is again reasonable. So two things, like from say fundamental delivery perspective, both Bajaj Finance and Chola have delivered good numbers, probably the best of the numbers in their own domain. And at the same time, because the stocks have not done well, the valuation have become a lot more reasonable. current valuation address many concerns. Like in case of Bajaj Finance, there was another concern related to say management change, which is already known to the market. And the format change, like if NBFC becomes say bank, its implication on the PNL and so on. Its current multiple already reflect those things. So the moment the so-called concern related to credit cost is being addressed in coming quarters, and the earning growth also say follow the pace of the top line growth, we expect that the things should come back. At the same time, like from overall risk control perspective, I have already mentioned that we have taken out Bajaj Finserv. So currently the overall exposure to that particular entity, you can say almost 50% vis-a-vis what it used to be, say 5-6 months back.
Yeah, thank you, Kuldeep. So Kuldeep, we don't have any further questions in chat box now. So request your final conclusion remarks for the participants, and then we will end the call.
So the way we think about it, like post general election, there had been some change in the narrative, like capex not happening. There may be many reasons for it, and Q2 extended monsoon also have some implication. We have a strong faith and believe that probably in second half onwards, the thing should catch up. And for many years, the country need infrastructure, manufacturing, and capex. It should happen. And if it happen, then our portfolios are quite aligned to that particular theme. And earning growth was never a challenge. Like by the last 5 year, last year, it's being delivered. And portfolio returns are combination of two things: earning growth and the valuation. So earning was not an issue. It's being delivered in past and should continue to be delivered in future. The valuation have come down dramatically, if I have to say so, for the market, and even more so for our portfolio, because growth as a style had some issue. So there is meaningful derating which we have seen in last 2 year or 3 year, and probability that here onwards the further derating happening is relatively lower. If the valuations are not coming down further, then our large part of the earning growth should translate into the stock return. That is something we are expecting.
Thank you, Kuldeep. Thanks for your time, and also thanks to all the participants who joined in this webinar. With this, we end today's webinar. Thank you so much once again.
Thanks, everyone. Thanks for joining. Have a good day.